Good evening. This is the Eye of the Storm podcast for the S&P 500, the NASDAQ 100, the Treasuries, including the 30-year bond, the 2, 5, and 10-year notes, gold and silver, and the U.S. dollar. For Saturday, December the 17th, 2022, good week all around as progress was made on the counts within each of the markets that I cover. I'm going to begin with the SPX because here in the podcast, in the Eye of the Storm podcast, I'm going to cover the cash markets. So it'll be the SPX, the NDX, and then the 30-year bond. Those are futures markets. But of course, they're based on the bond. So beginning here with the S&P 500, here I have my largest picture, and it goes back to 1928, I believe. Yes. And, oh, I take it back. It actually goes in, yes, 1928. And so I went back to find the beginning point or the low for supercycle wave 2 and the beginning point for supercycle wave 3. That was back in 1932. And from there, and I believe that low, so I can just double check by doing this, going very quickly, $4.36 was the low in 1932. The high was $4,818 in 2022. Quite a beautiful run, et cetera, 90 years, almost to the point. The low was in June of 1932. The high was in February or January of 2022, excuse me. Now, what we have progressed in is, I believe, it's just a very, very, very dynamic rally to complete a cycle. Degree wave 5 was an incredible rally. And I want to take a look at those because if you remember, what I'll talk about here is, of course, what's going on within the S&P. But I want to then make reference to what I call the pecking order. And many of you that have been following me for a while understand that I discuss this every now and then. And the pecking order, according to me, would be sitting up at the top of that pecking order are interest rates. And then underneath interest rates, we have the dollar. So we have the interest rates in bonds, and then we have currency, and then we have corporate, which is, of course, our equity, our markets, and then subsequently, then we also have the future. But also within all of this, we have precious metals and other things that all come into focus. But on our pecking order, we have interest rates, then we have the bond market, then we have the currency, and then we have the equities, corporate, so to speak. So interest rates, the currency, the corporate, our companies, and then the retail, us. So we're all the way down at the bottom, and then it always will roll. You know what they say. So it will roll down to us. So when we're dealing with the interest rates and how that flows down, it goes through the dollar and then into the corporate as they then have to function and put it through all of their models so that we can get an idea of how all of this higher interest rates and movement and volatility is affecting, and also what's happening in the globe is affecting how they operate, what it's costing them to operate, et cetera, et cetera. And then that in and of itself ebbs and flows. So here we are, we're sitting in. Now I want to just talk about this and this. This was 2009. In March of 2009, the market, the S&P bottomed at 666.79. And we'll leave the number alone and we'll just call it 667. So the market bottoms, finishing a cycle fourth wave in 2009. That 2009 collapse was a financial economic collapse for the United States and for many ways the globe. But here in the United States, we saw bank failures. We saw up and down failures of a lot of different industries, and a lot of things that could just go wrong went wrong, particularly to corporate. Now, what came out of that and what was created here was an injection of capital by the United States into its own corporation. So there was bailouts of the banks, bailouts of corporations, bailouts of whole sectors, because we needed to get people, continue to have people working. Many people were unemployed because the company went bust, the bank went bust. So a lot of stuff happened. Capital got injected into the system. I believe it was somewhere around $8 trillion by the time it was all complete. Well, boom, 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 boom. Interest rates start to come down. Boom, 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 boom. The money gets cheaper because we have to create an economy that will function, pay its people, and continue to churn on a global basis. And that's pretty much what they were successful with. You can see it. Then along came the pandemic. Kaboom. And then what had to happen after that? Well, now, not only do we have to bail out corporate, but we have to bail out retail because they can't get up and go to work. They have to stay home and work. So we have to support the corporations to keep them working, to keep what semblance of an economy we could have going so that people could continue to live. And there's a lot of figuring out that went in there, but end factor was $13 trillion went into this run. And you just need to take a second and look at the steep, absolute reaching and screaming for the stars. Why? Because money was not only cheap, it was like, oh my God, I'm not paying any interest, and I'm able to borrow a lot of money from the government. Now, the government, of course, wants that money back because it now needs to get it back in because it was given away too cheaply. So what happens with all of that? Well, we can see just on an Elliott basis, we completed a very large 5 waves up. And even on, and then we look at the bonds, the price of the bond, yes, they did 5 waves up. The yields did the opposite, did 5 waves down, right? High to low. So corrections are at hand. And as basically almost a minimum, this is the period that sorely needs to be corrected. But what we have to go on is the entirety of the move goes much longer term, much more. So when we need to figure out what ultimately has to happen here, is that we are now going to be forming an super cycle wave 4. That's what we are in the beginning stages of. We're not even halfway through the first, we're likely halfway through the first leg, the larger leg, which is a cycle degree A wave. But within it, we have to look at a lot more factors. But what's getting corrected? In all honesty, this excess, this calamity, and it was not any one person's fault. I would imagine that some of this financial collapse, yes, we can tie that to a lot of factors. And so anyway, we'll move on from that. But there were many factors that went into that lessons needed to be learned, and they haven't been. Here's the case in point. All of this, along with that, and then another jack like this. It was cheap money. So now you know why people say money has to keep flowing. The interest rates have to stay low if you want to see this continue. Well, the reality is, it's like to keep them low would be to be paying. You would end up paying the banks to take your money because you're not going to get any return. There would be a negative interest rate. That's where you pay them. And there's no guarantee that you'll get anything back. So very hard situation. Now, on an Elliott basis, if we are looking for a super cycle, wave 4, and it's going to correct all of this excess, all of this building, all of these rallies. But more importantly, it's truly going to be correcting that 5th wave. And because of the entirety of the project here that we got going, then we're going to be looking at, it's going to be correcting the whole thing. So the last 90 years of economic calamity and economic successes and excesses, because that's what the final stage was. Now, what under Elliott, what does this tell us? If we're in a supercycle degree 3rd wave, and we're looking for a supercycle degree 4th wave, under Elliott, his observations were that that 4th wave will find its terminus, find its ending point within the price territory of the 4th wave of 1 lesser degree. Now, just think about the size that we're talking about here, and you're going to get a clearer understanding. So if we're correcting a supercycle 3rd wave with a supercycle 4th wave, it is more than likely going to be coming in to the price territory of the 4th wave of 1 lesser degree, which is cycle. This cycle 4. That's where it started. That's where it finished. So we're talking within this zone. Now, where are we within that? We're in the first. So supercycle wave 4 will consist of 3 waves, an ABC of cycle degree. Well, we're breaking it down further. What's inside that first wave A of cycle degree is an ABC of primary degree. Well, again, we break that down. What's inside that first wave down on the primary degree? 3 waves of intermediate degree. So, and what we're working our way up to is the bottom of this cycle degree A. But I need to show you that the potential now that we're going to come down into here is very real. What initially is going to drive it? We have many, many factors, but it's understanding that this excess money needs to be reeled back in. Otherwise, it churns on itself, and many things that aren't pretty can happen. Seriously. So that's the Elliott view. Now, I'm looking for a cycle degree A wave. That's my first big move down. I'm going to come out here now to the hourly chart, because in essence, since I'm only dealing with that cycle degree A wave, I'm just going to keep it in that frame. And that wave, I'm looking to find its endpoint within the 4th wave of 1 lesser degree, and that's primary. Still working on a correction, so I'm still following Elliott. His observations were look towards the 4th wave of 1 lesser degree from the one you're counting. I'm counting a cycle degree. Go down 1, it's primary. It should, that A wave should find its support somewhere in here. Then, now, where does that come in the bigger scheme of things for this? All right, and we're counting the A wave down. Well, we've got this here at 29.79, and it's actually 3,000 down to 29.80, we're going to call it. Well, could that finish the A wave? No, because we're in the primary C wave down. So I think what we could be seeing is that we're going to get most of it done, but we have a very strong possibility that this is the intermediate 3rd wave, right? Now we're breaking it down again. Looking for the A wave on a cycle degree, come inside as an ABC of primary degree. Well, A and B are done. We're in C. What's in primary C? 5 waves of intermediate degree, of which 1 and 2 are now complete. We're beginning the 3rd. And it's kicking off pretty cleanly right now. Again, weekly basis, here we are. It's the SPX sitting right on. We touched and closed just above the weekly 200 EMA. That's a 200 period moving average. We have larger picture support at 36.82, already been broken once. So just a pause for the cause. but I don't suspect that it's going to hold. So what are we looking at of this third? We're definitely looking for it to break 35.02, which was the low in October. Now, what comes up next? Well, the 382, that's pretty strong. So maybe the third can get 3,029.80. Then we get an intermediate fourth wave, and then we have an intermediate fifth wave, likely sometime, of course, because we don't have that much left for 2022. So out in 2023, we're going to get the bottom of this intermediate third wave. We get an intermediate fourth wave, intermediate wave 5. Boom. We're down into the price territory. We are at this level. We're going to do it again. And then we're going to put in that A wave. So 1, 2, 3, 4, 5, somewhere in there. Then we get, I've been talking about it, a very strong cycle B wave. Now, bear all of that in mind, because I'm going to continue now with the NASDAQ and with some of this weekly big picture view here for the S&P and the NDX, but I need to move over to the bonds to put the balance of the picture of what can be happening in an A, a B, and a C, because they're all going to go together. It still surrounds interest rates. So if this is what the picture is telling me in equity markets, what then can I transfer over and take a look at, and what's going to concur with it if I'm looking at a chart on the interest rates? And then again, how is that going to concur with the possibilities of what looking for or expecting in gold and silver as compared to with the dollar? But I'm going to bring the dollar back into the conversation about interest rates, because that's where it all begins. All right, so in this market, based on the weekly chart, I would expect this 200 to break, and that we do get a weekly close below it, which will be signaling we are headed lower. Now, what's going to cause it? We already know. The market has now got to adapt it that the Fed is not going to pivot. We got additional word on that from Chairman Powell last week when he stepped up to the mic to tell us. Yep, we got a little breather. They said, okay, we'll consider going down, and they did. They only jacked up the interest rates 50 basis points instead of 75 basis points, but made it very clear that inflation is still a problem. Inflation is still out there. Inflation still needs to be dealt with, and they still intend to have additional rate hikes. Once that news was made very, very clear, and what the numbers are showing us, the market began to take its cue and started to sell off again. In fact, we had a fairly strong balance of the week starting on Wednesday afternoon, and then picking up again on Thursday, and then again on Friday. So I suspect that that's all going to continue as the third wave continues to unfold. Inside of that third wave, and this is where I will just get to some basics. We are in the beginning stages. We may have just completed the minor wave 1 off of that high. So yet to be seen. And that I will pick up and I will cover in the Elliott Wave updates. And that one I will be doing tomorrow after the markets begin in Globex. Okay, so going over to the NDX now, which is the NASDAQ cash. It is basically the same story all the way up. I'm going to go back out to my monthly max, but here I'm talking that what really we're likely correcting I'm going to go with is the cycle wave 5. That was the injection of a lot of capital, because the market, the NASDAQ actually did a major collapse in starting in 2000 down to 2003, I believe it was, or at least 2002, when it reached its lows. So in 2 years, the NASDAQ lost 87% of its value. And from that low, so that was the NASDAQ crash, basically, it rallied. So the low back in that time was, I believe, 749, 795, 795. And that was in 2002. And 2022, in 20 years, the market topped at 16,767.50. quite an enormous feat. And there is the financial collapse. That's the NASDAQ collapse, just corporate just dying. And that's the financial collapse. Pale, but damaging. Now, if we're coming in, so 2009 lows, as I'm basing with the NASDAQ basically to 2003 lows, but I'll use that for the purposes of this long-term picture. So in any case, what I'm now presenting is I go from the low of cycle wave 4 to the high of cycle wave 4, because that's the excess. That's the period of excess, where excess money was pumped into the market, and this is where it started. So we got the same results, and then we had that same pandemic, and then it went vertical. Big hits here and there. China war, this war, that war. But it just went vertical. The buyers didn't stop. Bam, suddenly we're back in. And because the tech and what they were all doing, and they were doing splits, and they were doing buyback programs, et cetera, just to reissue. It was crazy, but it was truly based on cheap money. That's it, cheap money. Corporate could borrow money, buy back their stock, regurgitate that stock by cutting the price, getting additional funds in. Amazing trick, but it worked. And everybody, instead of having 100 shares, they did 20-for-1 reverse splits. Now suddenly you have 2,000 shares, just at a lower price, but still we've given you 20 times the number of shares. Well, that's a lot of money in a lot of hands that when it starts to go down, it doesn't look as pretty. And so we see a lot quicker exodus in these bigger stocks that actually got extremely overvalued in the process of the corporation buying back the shares and having a buyback. And that was just to reissue. So it's pretty crazy. But in any case, it was a lot of excess, and that's what's being corrected. Now, here in the NASDAQ, we have 0.236, 0.382, 0.5, 0.618. These are the magic numbers. Here, excuse me, is the pandemic low. So I'm going to go over to the weekly chart. I'm hoping that I've got one on that goes actually 3-year. Yep, that's fine. That's what I want. There's the pandemic low. So what I'm looking at here is exactly the same thing, but here are our pauses, and here are some major support. 10,600, bing, bing. We've gotten there twice, and we've got below once, and we got down. That low there was 10,440, but boom, we took it right back and took it back in high fashion. Came down in October and reached 10,632, and then rallied up into that minor wave 2. So again, intermediate wave 1, intermediate wave 2. We've come down to this line twice, bounced off it. The third time, I think we go through and we keep going. Why? Because that was my intermediate wave 1, and this is intermediate wave 2. Intermediate wave 3 would be expected to break that and keep going. Where are we headed? Well, there's our first target. What am I looking for? I'm looking for, and I do use a super cycle 3 in the NASDAQ. I have to, based on the commonality between companies in the NASDAQ and the S&P, et cetera. So that would suggest that we're still doing a cycle degree wave A down. And if that's the case, here's A, here's B, we're in C. Looking for at least the A wave, right? Primary C, maybe we got minor, intermediate wave 3 brings us down sub 10,000, maybe as low as 9,000 or 87.95. We do an intermediate 4, and intermediate 5 brings us right into here. Primary wave C, cycle wave A. Ding, 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 ding. We have a big rally. Then we get a cycle wave C. And cycle wave C could be pretty hard. Then we're going to be looking at, like 55 or a little bit lower. If we're thinking that it could go and start getting towards this or even these levels in a massive C wave down. I kind of come into here, but we go further if we're comparing it even to the cycle fourth within the other equity markets. So again, I'm looking here at this 4. I'm always going to be looking at fourths. So that's why the 2, I'm not really there, but that's where it is. So I can go, therefore, that's a 4, and then I got the bigger 4. So I'm thinking right in here, we get that ABC of cycle degree, and then begin the next larger expansion higher. And that's still out there to come. So we still have a ways to go. I'm going to bring it back down to that weekly chart, and then we're going to slip over and we're going to start looking at the interest rates. So here, same deal. We're in the beginning of that third wave. I'm looking for the third wave to really carry through. But it's not going to be easy. We should get some strong days of just like bam, 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 like here. Stronger days like here. Where it's just like push and we're going down. That was a longer period. That was 1, 2, 3, 4, 5, 6, 7. 7 basically. And then we have 8, 9, 10. So overall 10 with 1 in between of a pretty strong rally. But we had enough to really knock the market into that type of a third. We're now back there. We should get another move like that. Okay, enough with the NASDAQ. Let's head over to the 30-year bond. Now, again, remember interest rates. Now, we're going to go jumping over here. Let me get out to my monthly max. So December the 1st, the rates were 3.64, 30-year bond. Now, just to take a recap real quick, at August of 1981, the bond yields topped at 14.49%, 30-year bond yield. And April 20th of 2020, they bottomed, right, yield low at 1.17% on a 30-year bond. December 1st of 2022, we were at 3.64. December 16th, we were at 3.54. Remember, out of this little move right here, I'm looking for an ABC. And what it's going to should show is the up waves should show 3.4, 3.5. And then we get a B wave. So we're going to go back. We will have higher rates in a B wave. Well, I'm looking for that pretty much right now. I've been looking for this completion of an A wave up. I'm going to go down to the weekly chart pretty quickly so that I can show this, right? So again, we're into the bond market, so we have to realize that when the bond price is high, the yields are low. When the bond prices are sinking, the yields are rising. You get paid more interest. When you get paid more interest, what's the compound? What happens? Well, I'm going to get more for my dollars. I'm going to want dollars. I'm going to need dollars to lend it to the bank to get that rate. Lend it to the Fed to get that rate. Whomever, you need to convert into dollars. We'll see a lot of that. So again, if I got a 1, 2, 3, 4, 5, I think this might just be A. Right? 5 wave A. Here are our levels for what we can see in terms of this whole move. And I'm on a weekly chart. So already we've been 1, 2, 3, 4, 5, 6, 7, 8. We've been 2 months correcting off of that bond. So 2 months. So we've been correcting to the upside since October. And the market has kind of gone through its gyrations of putting in an intermediate wave 2. Now the market is beginning to slide in intermediate third wave because it's realizing that over a little bit longer term, interest rates are going to continue to go higher. Well, right now, they're not. but we've just done a 1, 2, 1, 2, 3, 4, 5. And that 5 might not be over. We still got to the end of the year. So we still might creep up and make it a little bit higher, but they may have. And that high right now is 132.23. So, but we don't have any stronger fib resistance until 135. So there is that possibility between now and the end of the year, we do that little bit of a pop. Now, again, against in the equity markets in those indices, yeah, I'm looking for the possibility of a minor wave too, but it's going to be a counter trend rally. So while we dip and get ourselves up to 135, the market does have the potential to actually put in a small minor wave too. Now that maybe it takes a week, now we're into Christmas. So again, looking for the possibility, but I think this is a 5-wave, and it's only going to be wave A of an ABC. And that ABC is like A up, B down, C up. Remember, when we're back in trend, which is pretty much this, did 5 waves down. I'm convinced, or I'm pretty sure about that. So I'm looking for an ABC. Well, we could get a 5-wave wave A is telling us zigzag. So I think eventually we are going to end up somewhere up here 145. I would have to go do some math to tell you what the yield would be, but I'm going to talk and think that 117 to 135 is going to bring us, I think what this level was just over 4. And now we're 3.5. So is that 3? The 3% yield? Maybe. Or a little bit lower. But don't forget, we're talking 30-year bond. So ABC, I think we've done or very nearly done the A wave. We're going to get a B wave decline. And again, what am I going to look at there? I'm going to use retracements. Let's just open that up a little bit. And we have ours that we want going. And I'm taking it from if 132.15 is the high, okay? If right now we're allowing for an additional 3 points here. 3 percentage points, or just $3. Okay, so here can happen, but right now taking it from here on a B wave, you're looking for 382, maybe 618. But right now, the pressure could be on for them to drop, but I don't think they come, or it could be a flat. But being that this was 5, I'm looking for nothing. I'm looking for 382, maybe 50 in its own ABC. Down, up, down. Then another 5 waves up. And I think that can bring us up to here. So we're looking at somewhere in the first half of 2023 that we're going to see this secondary rally in an ABC. Bigger picture. There'll be a lot of dipping and all moving around in between. Okay, so let's take a look at the 10-year note. Interest rates kind of would be are seeming to all roll around 3.5, at least between the 10 and the 30. I go here, and you can see that the Treasury yields reached their low in May of 2020 at 0.69%. The 10-year note reached its price high in May of 2020 at 140.240. All right, so but in September of 1981, 10-year note yield was at its high, which was 15.30. Now, December 1st, 2022, 3.53. December 9th, 3.48. December 16th, 3.48. So here we kind of got a little dip, another little dip. Maybe we go back towards here or a little bit higher, right? Because that's our monthly. Here's our 5 down, clean. We're going to do an A, a B, and a C. Let's take it down to that weekly, see if we can get that same type of account, and we can. So again, nice, clean 1, 2, 3, 4, 5. I'm actually on my weekly chart. I know there was questionable as to what. And I think that the 10-year note does have, I think, maybe even a little bit stronger potential than the 30. I don't see them going separately, but I think we could continue to move up and get as high as 116.115, which is 236, before we complete that A wave here in the 10-year note. Then we get a B wave. Then we run the C wave. Excuse me. And I am thinking that eventually we will get to 121. And with the yield is there, this is pretty much 3.5, give or take, a couple of tenths. And then another 5, and this was 7, another 5. So what are we looking at? 3.5, 3. So if we're looking at 3, at the possibility of things will surround 3% on the 30, 3% on the 10-year note, and then start the climb once again. And primarily the reason is because 5 down is never going to be a move all by itself. So that's not the low, or that's not the high in the price of the bond, that's not the low of the price of the bond. So we will go up in a corrective move. I mean, there's potential for that ABC up to get up to 124, but right now the first target would be 121. Again, it'll be structure because here we have a zigzag. And when you're studying Elliott, they're the two basic forms for corrections. You have a zigzag, which is a 5-wave wave A, a 3-wave wave B, and a 5-wave C. So they're also called 5-3-5. Whereas a flat, which is the other structure, which would be A, B, C, and the A and the B are basically going to be pretty much very close in size, with the C wave also being close in size, but having a tendency to just kind of go a little bit further than the A wave. So here we got a nice 5 up, which may be complete, and we still need one little more push. And then we get a B, and then we get a C. So same thing here. And we'll measure it out. You'll notice here on the weekly, we got the 20 kind of going flat, the 4, and the 8 are still rising pretty strongly. So they're not even really hinting quite yet of giving up for a B wave. I would say we maybe got another little bit to go. Now the 20 is flat. So what that tells us, we might just hang out here, maybe go up but come back. So it could be a quick move as well. Coming down to the 5-year note, all pretty much the same. Let me go back out to my max chart, and you can see that here a little bit clearer. 1, 2, 3, 4, 5. We got it all nice. So on the 16, 361, we're from 375. So maybe 3, 4, and a 5, right within this. And so again, 5-year could be done with the A, but it has room. The high thus far is 109.290. Well, we have 236 sitting at 110. So that would be nice. And then get up there and give it a little touch. This is on our monthly maximum chart. So we have the monthly max 8 at 110.190. We've kind of we've popped above the 4. Kind of made it close, still right there. So I think we still maybe got a shot, a little bit more upside. Then we'll put it a B wave and we'll do a C wave, ultimately ending up somewhere around 113. Next year. We got some time on that. And lastly, I also have the 2-year note, which you can see that the interest rates are going to be a little bit different. The shorter the time frame on the bond or the note, the rates are going to be more in tune with what the Fed is doing. So we're trying to stop the short end of the curve by keeping the long end of the curve a little bit more stable and not jumping as high. So I've read that some are estimating that like the 30-year bond or that tranche of bonds could get us 5%. That's not that bad. It's going to put a real crimp in a lot of things, and it's going to take away a lot of money. And that's the whole purpose of like trying to make an adjustment for inflation, is to get some of it back. We need to get some of it back. The excesses of that amount of money that went out into the system needs to be put somewhere else and not in circulation. Hate to say that, but that'd be the truth. Now, here we are, 2-year note. So on December 1st, well, first of all, and in April of 2021, we had the yield low rate and the bond high price in April of 2021 at 0.17%, 2-year note, where basically you got nothing. But here we got people bought that bond because it was like, okay, somebody else is going to come behind me and buy it. And we ran. And now look. And because of the sensitivity to what the Fed actually is doing on a short-term basis, the 2-year note collapsed very quickly and very cleanly. So this ABC would have to coincide with the Fed actually relaxing a little bit. And I see that can happen in the B wave, in the B wave of the equity indexes that we're looking for, a cycle B wave. The interest rates have to kind of coordinate there. So in other words, it's like we can't be racing higher. So there has to be some relaxation or slowing of the rate hikes, maybe a little bit of relaxation because we've reached a plateau, maybe even with inflation, not yet at target, but we'll be told that it's going in that direction and that it's looking pretty strong, that we will reach our target, right? And so, boom, enough to turn, and then with what money is left will be ripped back into the market because we're all going to try to make it back. So, and then we'll get that C wave, and then here, 5 waves is never going to be all done by itself. So wherever we get this ABC up, whether it's here or even possibly here, the market will still do an additional 5 waves down, and it will resemble this, but coming from a lower high once again. So markets will correct twice. It's kind of an old Elliott term. And Elliott said, the market will eventually correct itself twice. So you reach a secondary high and you come down. When the markets crashed in 1929, there was the first drop, and then a B wave, and then the C wave was the crush. The C wave was what knocked everybody to the streets. The C wave is what brought in the depression. So, A wave, not so bad. B wave, everybody believes the world is good. C wave, crush. Here, I'm going to count it as an ABC. And then that's going to be it. And it probably cycle degree because I don't go above cycle in the treasuries. So that's it for the treasuries. Going to go over now. I am going to go to gold. And we'll do the dollar last as I did last time. Gold remains in the same position where if I'm looking at my monthly max, it's still not looking so bad for the markets to kick it up a notch and go and start to rally. However, when I bring it down, and I start looking at the weekly chart, I'm like, what are you guys doing? You had a down week? After making a new high for the sequence, okay, so I was looking for from here. Nah, I don't really see a lot of corrections, but I have to think maybe there are some in there. Is that a 1? Is that a 3? Is that a 4? And this is a 5 when we're correcting. So 2 basic down weeks. I'm not real pleased with that pattern, I'll tell you. So I'm not able to really say, okay, how much do I trust that we finished this minor 4th wave? That still can be the case. And if I'm looking out at, even just go to my monthly 20, what we're looking at is the possibility of being into or finishing up a primary 3rd wave, or excuse me, an intermediate 3rd wave of a primary 3rd wave. So, and here within the minor degree of this primary intermediate 3rd, we're beginning the 5th wave. It should take off. It should outdo this. It should smoke this pretty quick. And we had some decent days in there And that's, if this is 1, we get a 2, that 3 should just cook it, right? It should make itself known. Again, what's behind gold? A lot of it is, of course, we tie it to our currency. What's happening in the dollar? Higher dollar versus a lower dollar affects the price of gold. And there are different schools of thought on that. I think what really is behind right now is that when you're dealing with a fiat currency, it's not backed by anything except the good faith and credit of whatever country is issuing that money, that currency. And we're moving into a period where we're going to be living digital, and there will be digital money. So digital dollar, digital ruble, digital yuan, digital yen, et cetera, et cetera. It's going to be crazy, but it's similar to kind of make your mind adjustment that Europe went from individual currencies to one. Now, not that we're going to have one world currency, although one day it may, but we're going to have a lot of different currencies, but they got to be backed by something. Because if it's virtual, right, that's what happened. Digital, it's virtual. It's moving digitally, and you're just kind of getting a note, well, you're this much richer or you're this much poorer. So you don't have something tangible to hold in your hand. So it's taking the physical money away from people and putting the control of it to a central bank. Now, there's a lot of hoopla. But if there's going to be any faith to do business in these digital currencies, then that currency needs to be backed by something that is globally accepted as a valuable asset or something that could be considered a storehouse of value. The currency itself cannot be considered a storehouse of value because the currency can go hyperinflation down to 0. Who knows? If it loses all of its value, countries collapse. Things have no value, but there has to be something that backs all of this that we could run to that does have value. And unfortunately, or fortunately, it is gold. It is something that there's a limited supply of. And if people are out there buying it, if countries are out there buying gold to back a digital currency, you tell me what the price is going to do. And that's what we see. We see these big, big gains, and then it kind of drifts off. So a lot going on, but I believe that should continue. And so I'm going to leave this count just as it is, coming down to that weekly again. I'm concerned, but as a long-term investment, I have no problem with gold at these levels and buying gold at these levels if you have that kind of a portfolio, or picking up gold coins or picking up silver coins. I think that's all smart. Even if it's coming down, you just kind of get yourself in. The whole upper picture is still got a lot to really unfold. And there's just too much out there that can really change everything. So, gold. Now, so I still hold there. I don't cover this on a day-to-day basis as I do with the Elliott Wave update. But even within it, it's not that bad. But just we have rallies, and then we got these days where they just kick it. Now we have rallies, and then they just kick it. And that's due to the dollar-euro. The euro and the dollar right there. All right, so enough on that. Let's go over and look at silver. There's nothing really changing in silver either. We got a lot going on in the dollar, and we got a lot going on in the interest rates, but silver still carries the larger potential, in my view, of putting and mounting a massive rally. Massive. Because I'm looking at things trading at 23, and there are times that they just drop it to 18. And I'm thinking, well, if I'm thinking we're going to be in an intermediate third wave and we've just begun, we get a little wave 2, a small wave 2, minor degree, and then we're just going to blast. And I'm thinking 29, 30, 40, 48, 50. Yes, he said. 58 is where that this primary third wave will be equal to the primary first wave on its way to finish primary 3, 4, and then 5 to finish cycle 5 and start all anew, right? Cycle wave 3, major top. Cycle 4, major low. We're in that cycle 5. Remember, fifth waves in the precious metals and many commodities is where you get your blow off, not just 1, 3, because we get another one at the top of primary wave 3, and we'll get the last one at the primary wave 5, cycle wave 5 high. So there's a lot of room in silver over the next, right? Look at this, 1980, 2020, all right? So this was 2011. So 31 years, and then basically 9 years to get down, and we're just starting this cycle. So I'm expecting this for many years to come. All right, enough in the silver. Let's get over and finish up with the dollar, because I realize I've probably been talking for a while. Dollar is again presenting something very interesting to me. I don't have the long-term count, so I'm just basically counting 5 and then knowing that I need to do an ABC. And whatever degree I'm going to call that, I need to do the same thing in an ABC. So here I have 5 down. I'm looking for that ABC up. I get internally A, B, and a nice C wave. That finishes the A, B, C. That finishes the B. I'm looking for another 5 up. 1, 2, 3, 4, 5, 1. This is 2. And we're going to get a third that's going to pretend to be very, very harsh for a C wave. But if I look at my extensions, the start of wave A, come on, pup, to the top of wave A, to the bottom of wave B, we're sitting up there. Where's 100%? 122. Monthly max now. Boom, 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 boom. I'm on the monthly max. Okay. 122. This high is 120. Does it get above it? Yeah, it can. And still be within this C wave. But I'd like to see the C wave 115-ish, maybe 120. And if I come into here, ABC, right, it does fit. But this is kind of, I'm not sure. So bringing it down to the weekly, I can look into this. 1, 2, 3. What's this? AB. I'm not sure, because I can almost look at that as 5 down. And that would suggest that this is done. And that would suggest that the dollar rallies from here. And then I'm going to, at first I'm going to remove this upside and look at what if we just do, what if this is 5 down? And now we're just going to do 3 waves up. Come on. What am I looking at? Because again, what are we looking at interest rates? We're looking at interest rates to be doing an ABC. All right. Interest rates are basically balancing out and coming around 3.5. Well, that gives us an opportunity. We get out of the dollar positions where we're going to roll. We're going to do something different. And then here we get 5 waves down as an A wave. The bonds do 5 waves up and an A wave. They're going to do a B wave, so rates will push higher. If rates are going to push higher, the dollar should go up. And where do we have it? Right now, I was just a little surprised that we got down below 104, but hey, we closed well enough above it last week that the break of that weekly 50, it happened, but the market closed and for the week above it. So it's not necessarily a hard break. Tight one, but it survived. So if it continues the rally, we got 106, 107, almost 108, and then 109, 50%. 618 is 110. So these levels, because we've been hovering around barely trying to get to 106 before we drop back down, we get back up, we drop back down. This has been now going on for a while. Once we broke it, we're staying below it. So this is where I think, okay, now we put that low in. We should put in a little bit larger ABC. And this is still the beginning. So what do we think for the dollar? I think in the dollar, we're going to play around. This is all pretty powerful, but not powerful. There was enough trading in between that you could do it on many different levels. So if you're just doing it in a cross rate dollar, or if you're just trading it as the DXY, well, there was plenty. There were some good trades. So you can continue to use that as your instrument, or just to follow what this is going to do, what interest rates we're expecting to do, and also what we're looking at the markets to do. We're looking for the markets to kick into gear. If the interest rate markets go through a B wave down, we're not looking for the world to fall apart, but it gets translated over into the marketplace as, okay, stocks, exit out of stocks by the end of the year. So we see that exodus continue, that moves over. Where are they going to go to? Well, we better put it into bonds, get a better yield. All right, if we're going to sit out what we think is coming next year, et cetera, et cetera. So we can see this transition happen. It's going to produce the waves. And then what do I get? We will get that cycle A wave low, a cycle B wave, pulling in somewhere when the dollar's up here and doing another serious decline. And that one would be expected to take us back below par. Par being 100. So, and then wash, rinse, repeat. Having this to come all the way that low, and then we get that cycle wave, C wave in the equity markets, and the interest rates begin to actually roar higher. It's just like we saw in the initial decline, we'll get another one from a lower high. Same thing in the dollar. We're going to see another intense rally in the dollar, but from a higher low. Okay, so you're going to have to go way out and look at these monthly max charts from a higher low. Maybe we finish up here, ABC, and then we get another, or we get another 5 waves down. So the market will rise up in the interest rates, but the rally up will begin off of a higher low. A, B, C, and then we're going to get that cycle wave C, and it's going to run itself back up in a whole different. So for all I know, ABC, I'll have to switch it around. Maybe it'll be an X wave. Maybe that is the C, and this is going to be an X, bigger X. And then we get another run for the roses. A lot of possibilities. I'm just putting the picture together as each component fits. Interest rates up at the top, dollar or currency, the next one down. Then you've got corporate, then you've got retail. All right, this is where I'm going to end it for today. Thank you all for listening. And the next Eye of the Storm podcast will be on, Saturday, December 24th. I think I may do one on the 24th, kind of as a Christmas present to lead us through that next week. All right. Have a great week, everybody.